In Halifax, we have Brian on the line. Good afternoon, sir.
Good afternoon, Mark and David. Enjoy your show.
Thank
David,
you.
I was wondering, I was thinking about buying either TD or National Bank, and I'm wondering, is it a good time? Which one do you think is the best one? Is this a good time, or should I wait for a pullback? Thank you.
Okay. Well, Brian, first of all, you are getting a bit of a pullback in all the Canadian banks. It's interesting. They all reported earnings. There were comments from analysts on each of them about what they didn't like about the earnings, and each of them have had a little pullback. They're all different reasons. There's no key theme. I think, frankly, they had a good run and are consolidating their gains. So I don't think that there's a big issue for these Canadian banks. We think conditions going forward continue to look pretty good. Return on equity is going to be sort of north of 15% for the industry. There's lots of room, I think, for them to continue to do well. Dividend growth will be good. When we look at National versus TD, the way I look at the world right now is we have globally, markets are not highly correlated over various geographies. The developing markets are not doing nearly as well as developed markets. We prefer to focus in developed markets right now. When we look at the stage of the recovery, the U.S. recovery is solidly improving. Europe is still fragile. Asia is a question mark. So North America is our focus, and specifically the U.S. is the most attractive area. So if I had to choose National or TD, I'd choose TD because of the U.S. exposure that they have. I think they're doing a good job down there. And I think that you get National more specific exposure to Canada. I think I'd prefer to focus on the U.S., so I'd go with TD.
And the way you describe that is a perfect example of your approach. You look macro and then you drill down and you wind up with TD. And you hold TD, or
we hold TD. It's a big position for us. And really, from a bottom-up perspective, we look for companies that are good getting better, revaluation candidates, and TD really is making some good decisions. There's some metrics that point to better numbers to come.
We are sticking with the banks. We have Michael, who's in Toronto. Good afternoon.
Good afternoon. My name is Michael Hughes. I'm calling from Toronto. I'm holding a lot of Bank of Nova Scotia stock right now, and I'd like to know generally your opinion on where that's headed and if that's a good play. Thank you.
Okay. So, Michael, of the Canadian banks, I think that Scotia is a very well-run bank, and you'd want to own it for two reasons. One, you want to own it when you have to own a bank and we're headed into a tougher environment. They tend to be more conservative in their lending practices. We're not in that environment. The second environment is where we think that some of the areas in South America are doing particularly well, and you want exposure to the growth outside of Canada. And I'm not sure that we're there either. Right now, if you look at the way the economies are performing in South America and Latin America, not as strong. They are seeing a little bit of inflation in some weaker currencies. So I think that in the short run, that exposure that they're building is hurting them a little bit. I think it's a good strategy for the long term. But when you look at, when you're in a decent market, you want to own things that people want today, that are participating in the strength today and right now. That Latin American and South American exposure is not really helping them that much, given where investor appetite is. So I think I wouldn't be a buyer of Scotia today. I'd look at another bank. And in fact, I probably would look maybe at a U.S. bank, maybe more particularly.
Okay, and we'll get to a U.S. bank in just a second. But is that an inherent risk with Scotia, even if things are going great guns, that you never know what's going to blow up internationally?
Listen, at any given time, you can own a great company at the wrong time and not make money. So this isn't a comment about Scotia's efforts. I think they're doing a great job. I just think the appetite is not there for extra exposure to Latin America and developing markets in general.
Right.
So it's probably in the short run a bit of a headwind that you may not want to fight in the current environment.
Sticking with banks and heading south of the border for this topic, we're talking to Jeremy. He's in Toronto. Go ahead. Oh, sorry. It's an email, and we're looking at an email here from Jeremy on JP Morgan. What do you think about it? I own it, but he also owns TD and Scotia, which you just talked about. Is there a need to own all three? That's a good question, actually.
That's a great question. I'm not sure you do need to own all three. I would go with TD and JP Morgan. We like JP Morgan. When we look at some of the big U.S. banks, they've gone through a tremendous amount of litigation and fee settlements and fine settlements, sorry. And JP Morgan really is the cream of the crop in the U.S. banks. They certainly have had to pay their share of fines, But coming off of that and coming off of the rebuilding of all the capital in the U.S. banks, we think that there is a significant opportunity for dividend growth going forward. And we think that JP Morgan will be part of that. So the valuations of U.S. banks versus Canadian banks, certainly cheaper. We think there is some concern by international investors about the Canadian dollar currently, so we could see some money continuing to come out of Canadian dollar, and that means probably out of some Canadian banks. You know, the banks are 35% of the Canadian market. Of the sectors that have been working this year, technology, consumer discretionary, healthcare, they really don't exist in the Canadian marketplace, so it's been a place Canadian investors have been hiding. I think there's more opportunity maybe in the U.S. banks.
Let me just play devil's advocate on JP Morgan. To me, it's intriguing that people just tend to shrug their shoulders. They turn a blind eye to Madoff, and the list goes on and on and on. Same regime is there. Are you not concerned that 3 or 4 years down the road, the tide's going to come in and everybody's naked again, and we find that there are more problems?
Realistically, they did the best job of anybody getting through the crisis. You know, if there was a crime, they saw the trouble coming and sold assets early to unsuspecting buyers. I'm not saying that was the right thing to do, but from a business perspective, they made good decisions going through the crisis and really didn't wind up with a balance sheet problem when other people did. Mm-hmm. So I think it's an exceedingly well-run bank. It's not certainly the only bank. We think some of the regional banks look quite attractive. And in fact, in financials, we would actually prefer to look at some of the insurance companies and asset managers above the banks that really benefit from a stronger equity market. One
of your top picks, as you alluded to, is a Canadian asset manager. We'll get to that later. Right now, though, we'll take a break and come back with the past picks of David Burrows.